Welcome to the U.S. Securities and Exchange Commission, Boston Regional Office Investor Outreach Program. My name is Jennifer. I'm an attorney here at the Securities and Exchange Commission, most commonly referred to as the SEC, and I am a member of the Investor Education Outreach Team in Boston. As some of you may know, the SEC has a variety of materials available at investor.gov for all investors on securities-related topics. We are also sharing this video about fees in an effort to help individuals invest wisely and avoid fraud. In this video, I will talk about fees and costs associated with investing and investment services and why they matter. With over 1,200 investment advisors and over 280 broker-dealers in the New England region, it may be difficult to decide which one is right for you. One factor to consider and compare when choosing to work with an investment professional are the fees they charge. And if you are already working with an investment professional, it is a good idea to periodically review the fees you pay. This video will go into some detail about different types of fees and provides an example of how fees impact your investment portfolio. This video expands upon the information in our on-demand video titled Introduction to Fees. Much of the information I will cover is available in the SEC's Investor Bulletin titled How Fees and Expenses Affect Your Investment Portfolio. At the end of the video, I will provide a link to this bulletin, but you can always find this information and more on investor.gov. Before I continue, I am required to provide a disclaimer. The Securities and Exchange Commission disclaims responsibility for any private publication or statement of any SEC employee or commissioner. This video expresses the author's views and does not necessarily reflect those of the Commission, the Commissioners, or other members of the staff. We are providing this information as a service to investors. This presentation is not a statement of official SEC policy, a legal interpretation, or investment advice. As with anything you buy, there are fees associated with investment products and services. These fees may seem small, but over time they can have a major impact on your investment portfolio. A recent report suggests that many investors are confused about fees they pay for investing. Here's an excerpt from this report, which comes from FINRA Foundation's 2018 National Financial Capability Study. It reads, "Analysis suggests that it is unclear to investors what type of fees they pay for their non-retirement accounts. While more than half of mutual fund owners report paying mutual fund fees or expenses, 57%, almost a third appear to be unaware that they are paying these fees, and 10% do not know. Among those who frequently discuss investment options with a professional, the majority, 60%, say they do not pay fees for investment advice. Furthermore, 14% of all respondents do not think that they pay any fees, and 17% do not know how much they pay in fees." The report also indicates that of those who responded to the survey with an estimate of their annual fees, including those who estimate they pay zero fees, only 60% are confident that their estimate is correct. If you are among the many investors who are confused or at least not confident about the fees you may be paying to invest, we hope the information we are offering today helps to explain. Before jumping to examples of fees and some math illustrating why fees matter, I want to bring your attention to Form CRS, a Customer or Client Relationship Summary, because it's so important to consider what services you want and how much those services will cost. The SEC has rules requiring disclosures. Every financial professional, meaning an investment advisor or broker-dealer, is required to give a Form CRS to you. These have to be short, 2 pages or in some cases 4 pages. They are required to be written in plain English, meaning they should be simple to read and understand. They are all in the same format, which is designed to make it easier to do side-by-side comparisons of fees and services. If there's any part of it you don't understand, you should expect the investment professional to be able to explain it. In fact, you'll also find conversation starters to help spark discussion with your investment professional. You can find a firm's relationship summary by visiting investor.gov, which offers a tool allowing you to check out your investment professional. Because you can simply access these forms online, you can easily make head-to-head comparisons between investment professionals you may be considering. When we are discussing fees, we want to keep in mind that there are fees associated with investment professionals, as well as fees associated with specific investments. Investment professionals, such as broker-dealers and investment advisors, differ in the types of services they provide and the types of fees they charge clients. Starting with the foundation question, what types of fees are there? Fees typically come in two types: transaction fees and ongoing fees. Transaction fees are charged each time you enter into a transaction, for example, when you buy a stock or a mutual fund. In contrast, ongoing fees or expenses are charges you incur regularly, such as an annual account maintenance fee. Let's look at each of these a bit more. We'll start by looking at transaction fees. As with any fee, transaction fees will reduce the overall amount of your investment portfolio. Examples of transaction fees include commissions, markups, sales loads, and surrender charges. Let's briefly look at each of these. First, commissions. You will likely pay a commission when you buy or sell a stock through an investment professional. The commission pays the investment professional and his or her firm when it is acting as agent for you in your securities transaction. Markups. When a broker-dealer sells to you securities it has in its inventory, it makes money by marking up the price, much like a store or any other seller would commonly do. And if you sell a security to the broker-dealer, there's typically a markdown. Sales loads. Some mutual funds charge a fee called a sales load. Sales loads serve a similar purpose to commissions by paying the investment professional who sells the mutual fund to you. Sales loads are called front end if you pay them at the time you make your investment. They are called back end when you get charged when you sell the mutual fund. Sometimes the back end fees are reduced or eliminated if you hold a fund for a specified time period. And surrender charges. These are associated primarily with annuities. An annuity is a kind of insurance product, and it generally runs for a minimum period of years. If you want or need to get out of your annuity investment, you may be charged a penalty called a surrender charge. The period when you would be charged a surrender charge is 6 to 8 years, but sometimes it's as long as 10 years. Generally, the surrender charge is a percentage of the amount withdrawn and declines gradually over a period of several years. Turning to ongoing fees, how do ongoing fees affect your investment portfolio? They also reduce the value of your investment portfolio. This is particularly true over time because not only is your investment balance reduced by the fee, but you also lose any return you would have earned on that fee. This slide lists a few examples of ongoing fees, starting with investment advisory fees. If you are working with an investment advisor, you should ask questions about these fees. Are you being charged both by the advisor who directs you to particular investments and by the company that runs the mutual fund? Can you get an offset? Annual operating expenses. Mutual funds and exchange-traded funds, or ETFs, are essentially investment products created and managed by investment professionals. The management and marketing of these investment products results in expenses and costs that are often passed on to you, the investor, in the form of fees deducted from the fund's assets. These annual ongoing fees can include management fees, 12b-1 or distribution and/or service fees, and other expenses. These fees are often identified as a percentage of the fund's assets. The fund's expense ratio, identified in the fund's prospectus as the total annual fund operating expenses. You should ask about these fees. Many mutual fund companies offer different share classes of their mutual funds. Sometimes you may be able to buy the same mutual fund without any 12b-1 fees. As some of you may know, the SEC has the authority to investigate whether violations of the federal security laws have occurred and can charge individuals and entities for violating the federal securities laws. Related to the current topic we are discussing, in March 2020, A jury found that a Connecticut-based investment advisory firm and its owner defrauded their advisory clients by repeatedly purchasing securities that generated significant undisclosed compensation, enriching themselves at their clients' expense. In certain circumstances, clients were invested in mutual fund shares with 12b1 fees, even when cheaper shares of the same funds were available without 12b1 fees. In July of 2020, the SEC obtained a judgment against another Connecticut investment advisory firm and its former CEO after alleging that each significantly overbilled some of their advisory clients. The SEC further alleged that both the investment advisory firm and its CEO concealed from clients that, on top of their advisory fees, they were collecting commissions for selling certain investments. If you are interested in learning more about SEC enforcement actions, please visit www.sec.gov and click on Enforcement from the menu bar. Turning back to other types of ongoing fees, 401k fees are another example. The expenses for operating and administering 401k plans may be passed along to its participants. This is in addition to the annual operating expenses of the mutual fund investments that you may hold in your plan. Annual variable annuity fees. If you invest in a variable annuity, you may be charged fees for administering the variable annuity. You may also pay fees such as insurance fees and fees for optional features, often called riders. You will also be subject to the annual operating expenses of any mutual funds or other investments that the variable annuity holds. Now that we have looked at transaction and ongoing fees, it is important to note that some investment products or services, including mutual funds, ETFs, and variable annuities, commonly include both transaction and ongoing fees as part of the structure of the product or service. For example, I mentioned surrender charges on the prior slide as they relate to variable annuities, and on this slide, we discuss ongoing variable annuity fees. You can compare the cost of various types of securities, including mutual funds and ETFs, by using the Financial Industry Regulatory Authority, or FINRA's, Fund Analyzer tool, which you can find a link to on investor.gov. Other fees you may be charged include fees for not maintaining a minimum balance, account maintenance, account transfer, account inactivity, wire transfer, or other fees. This is not an all-inclusive list. These fees may not always be obvious to you from your account statement or confirmation statement, so you should obtain information about all the fees you are charged and why they are charged. If you don't understand the fees you are paying, ask your investment professional to explain. Whichever type of investment professional you choose, ask questions and make sure you understand the fee structure and the level of service you're paying for. Let's look at some numbers to demonstrate how fees impact the value of your investment portfolio. This chart shows an investment portfolio with a $100,000 investment and assumes a 4% annual return over 20 years. We are looking at the value of the portfolio when the investment either has an ongoing fee of a 0.25% or a 1/4 point annual fee, shown by the blue line, a 0.5% fee or a 0.5 point fee, shown by the red line in the middle, or a 1% fee, a full point fee, represented by the green line. Notice how the fees affect the investment portfolio over 20 years. You can see the relatively small fee differences add up to tens of thousands of dollars over 20 years. Let me zoom in on this chart. In 20 years, a 0.5% annual fees, the red line, reduce the portfolio by $10,000 compared to a portfolio with a 0.25% annual fee, represented by the blue line. Comparing the green line with the blue line, in 20 years, 1% annual fees reduce the portfolio value, the green line, by nearly $28,000 compared to a portfolio with a 0.25% annual fee, again the blue line. You may be familiar with compound interest, which is a fancy way of saying that when you invest, you're hoping to make a return not just on the money you put in at the beginning, but also on any money you make along the way. In other words, in investing, the intention is that your money won't just add up. The hope is that it multiplies. Well, the opposite is equally true. Every dollar you pay in fees doesn't just come out of your pocket now. It also means there's one less dollar in your investment, so your investment will return less profit. These expenses compound, meaning they multiply over the years. That's why, when you look at this chart, a 0.5% difference in the annual fee produces a difference of nearly 5%, and a 0.75% difference in annual fee produces a difference of nearly 14%. What's a key takeaway here? This isn't about predicting future market trends. The numbers on this chart are based on math, and higher or lower fees make a big difference. At this point, you may be wondering what you can do, what steps you can take to better understand what fees you may be charged. First step, get informed. I mentioned in the beginning of this video that a recent study showed many investors are confused about the fees they pay. So, along with the other factors you think about when choosing either an investment professional or a particular investment, be sure you understand and compare the fees you'll be charged. Find out what you may be charged by reading what your investment professional provides you. For example, look at your account opening documents, account statements, confirmations, and any product-specific documents to see the types and amount of fees you are paying. I previously highlighted Form CRS. Registered broker-dealers and registered investment advisors are required to provide a new customer or client relationship summary, also called Form CRS, to retail investors. As we discussed, among other things, this relationship summary can tell you about the fees and costs you will have to pay for services. When I say ask questions on this slide and elsewhere in this video, I mean questions about the fees related to specific investments, as well as questions about how your investment professional is compensated. Questions you may ask your investment professional related to a specific investment include, does this investment match my investment goals? Why is this investment suitable for me? What fees will I pay to purchase, hold, and sell this investment? After all the fees are paid, how much does the investment have to increase in value before I break even? Does the product have more than one share class? If so, how do the fees compare across share classes? Some questions you might ask about how your investment professional is compensated. Directly ask, how do you get paid? By commission? How are commissions determined? Do they vary depending on the amount of assets you manage? Do you get paid through means other than through commissions and amount of assets you manage? And if yes, how? For more ideas of questions, you can visit investor.gov. Also, when thinking about what you can do, check your statements. Review confirmation and account statements to be sure you're being charged correctly, and ask your investment professional to break the fees down for you if it's unclear. The focus of the talk today is fees. However, I do want to take the opportunity to share another reason to read your account statements. If you have a brokerage account, you should read your statement every month. It may not be fun to look at when the market is down, but it is your most important protection against unauthorized transactions. If you do not object in writing within a certain period of time of receiving notification of a transaction, you might not be able to contest it later. That's why, in addition to using your statement to understand fees being charged, it's important to read your statement and object right away if something is wrong. A few more things you can do. If you still have questions after the first meeting, follow up. If your fees seem too high, ask additional questions and consider following up in writing if you are not satisfied. In some cases, fees are negotiable, so you can talk to your investment professional about reducing them. And shop around before you invest. Just like shopping around for the best price on any other product or service, you should consider how much you are paying for investing services. However, to the extent you decide to move to a new firm, you should think about any tax consequences and fees for closing or transferring your account. For example, Do you have to sell some or all of your current holdings in order to transfer? Finally, check the background and registration status of anyone recommending or selling an investment by using the SEC's Investment Advisor Public Disclosure Database, which is available on investor.gov. If you feel the fees charged to you are excessive, report your concerns to the SEC, FINRA, or your state securities administrator. Most of the information we went over today is in the SEC's Investor Bulletin, How Fees and Expenses Affect Your Investment Portfolio. The direct link to that Investor Bulletin is on this slide, but you can also visit investor.gov and search for the word fees. Before we close, here is our contact information. If you wish to report suspected securities fraud or wrongdoing, we strongly encourage the public, whistleblowers and non-whistleblowers, to submit any tips, complaints, and referrals using the SEC's online TCR system and complaint form at www.sec.gov/TCR. Also, I encourage you to check out investor.gov. It contains a wealth of information for investors and tools you can use to help you plan your financial future. For more information about the SEC and actions we are taking to protect investors, visit our website at www.sec.gov. And if you still have questions, please feel free to contact the Boston office at the email or phone number listed. Thank you for watching this video.